Imagine, 770 people rushing into a room.
Right.
All of them are frantically looking for a place to sit, but the organizers, for whatever reason, only bothered to add 25 new chairs.
Yeah.
Yeah.
That's a pretty brutal game of musical chairs.
Exactly. And that massive collision of supply and demand, that is exactly what is happening right now in the Q1 2026 multifamily sector of Coeur d'Alene, Idaho.
It really is.
And as we dig into this trailing 12-month data that CoStar just handed us, which, by the way, was provided by broker Eric Peterson at ACTIV8 Real Estate.
Right. Great data set.
Yeah, really fantastic stuff. If you want to reach him, his number is 509-903-9077. But looking at this data, we're seeing how that extreme bottleneck is fundamentally rewriting the rules for investors.
Totally.
And moving forward, for the sake of brevity, we will just refer to it as the CDA market.
Sounds good.
But if you are holding assets or, trying to deploy capital into this region, this deep dive is going to explore the actual mechanics behind those numbers.
Yeah, because it is a market operating under, honestly, severe mechanical stress right now.
Right.
Like when you have an absorption of roughly 770 units against a delivery of just 25 new units over a 12-month period, you're essentially watching the basic laws of real estate gravity warp in real time.
Warp how?
Well, supply is just completely failing to rise up to meet demand. It's stalled out.
And before we get into the heavy machinery of why that is happening, we need to respect your time as a listener with a bird's eye view.
Exactly.
Give us the quarter in a minute. What are the absolute headline bullets drawn from this data that set our baseline?
Okay, so first off, the total asset value of the CDA market sits at a massive $1.5 billion.
Wow, okay, $1.5 billion.
Yeah, it's not a small pond. Second, the 12-month sales volume came in at roughly $16 million.
Got it.
Third, market cap rates are holding remarkably steady, right at about 6.2%.
Okay, 6.2.
And finally, the market sale price per unit is averaging around $153,000.
So if we had to synthesize all of that data into a single reality, what is the takeaway?
In short, the CDA market is a tightly held, high-value landscape where intense renter demand is masking a near-absolute standstill in new construction delivery.
Okay, let's unpack this standstill, because the gap between 770 units absorbed and 25 delivered should theoretically cause absolute chaos.
Right.
I mean, the overall vacancy rate is sitting at 7.4%. And when you compare that to the broader national sector report, where, U.S. vacancy is drifting much higher, closer to the 8 to 9% range.
Yeah, the CDA market is visibly tighter than the national average.
But this is where I have to push back on the data a little bit.
Okay, go for it.
Basic economics dictates that if demand outstrips supply by a multiple of 30, the price of the asset, in this case the rent, it should just explode upward.
You would certainly think so.
We should be seeing landlords aggressively gouging the market.
Well, in a purely theoretical vacuum, yeah, the rent should skyrocket. But when we look at the actual performance, asking rent growth year over year is incredibly modest.
How modest?
It is sitting at just 1.6%, with asking rents hovering around $1,593 per unit.
Wait, how is that mechanically possible?
It's all about the ceiling.
Because supply is essentially choked off, right? You have hundreds of renters competing for whatever is available, but landlords are only bumping the rent by less than 2%.
Yeah.
Why wouldn't a property owner push it 5, 10, or 15% if the chairs are that limited?
Because of the macroeconomic ceiling on local affordability.
Uh-huh.
A market can only stretch so far before it literally breaks. Incomes in the local economy can only support a certain percentage of housing costs.
Right, like the old 30% of gross income rule.
Exactly. Landlords are, well, they're reading the room. They realize that if they push rent growth to 10% this year, they won't actually increase their net operating income.
Because no one can pay it.
Right. Instead, they will drive their own vacancy rates up because the local renter pool simply will not be able to clear the financial hurdle to sign the lease.
It is like an engine hitting its rev limiter.
Oh, that's a good way to put it.
Like, demand is still flooring the gas pedal, but the local median income is the computer cutting the fuel.
Yes.
The landlords literally cannot charge more without triggering evictions and empty units, which obviously defeats the entire purpose of owning the building in the first place.
That is a highly accurate way to look at it. The 1.6% growth points to stabilization after several years of wild, unprecedented swings in rent growth.
So it's finally leveling out.
Yeah, the market had found the mechanical limit of what the renter pool can bear. It is a tight market, but a stabilized one.
Hold on, I'm just connecting the dots here as we look at the next major trend in this report.
What's that?
We just established that landlords are showing restraint, right?
Mm.
But who are these landlords? The data shows that a massive 82% of the buyers in the CDA market are private investors.
Yeah, that's a huge chunk.
Institutional buyers make up only 7% of the pie, and real estate investment trusts, or REITs, are at a mere 4%.
What's fascinating here is that the dominance of private capital in a $1.5 billion market is actually highly unusual.
Right. Usually when a market has $1.5 billion in asset value, Wall Street is all over it.
Oh, absolutely. They usually dominate.
So is it possible that the reason we are only seeing 1.6% rent growth is precisely because institutional buyers are locked out?
That's a very sharp connection.
Because, mom and pop owners and local high net worth families historically do not use aggressive algorithmic pricing to squeeze every last dime out of a tenant, not the way a faceless private equity firm does anyway.
It absolutely plays a role in the operational reality on the ground.
Right.
A local family office or a private investor often values long-term tenant stability over aggressive yield maximization.
Because turnover is expensive.
Exactly. They prefer a reliable tenant paying $1,593 every single month over the friction and turnover cost of trying to force that rent to $1,700.
But that begs the question, why is private capital so utterly dominant here?
It comes down to market scale.
Because, why wouldn't an institutional fund jump at a market with 770 units of absorption? They usually love constrained supply because it protects their investment.
They do love constrained supply, but they require something even more crucial, and that is scale.
Okay, unpack that for me.
You have to think about the mechanics of how a massive private equity firm deploys capital. They have billions of dollars in, dry powder that they need to put to work.
Right.
It costs them roughly the same amount of money in legal fees, environmental studies, and due diligence to buy a $5 million asset as it does to buy a $100 million asset.
So they can't waste their time buying 20 small fourplexes.
Exactly.
Yeah.
The transaction costs and the brain damage of managing 20 different closings would just eat them alive.
Yeah, that makes sense.
They need a minimum deal size, often $50 million or more, just to move the needle for their investors.
But remember our first statistic, right? There were only 25 new units delivered in the last 12 months.
Right. And if developers are not building massive 300-unit Class A apartment complexes, there are no mega assets for Wall Street to buy.
Oh, wow. So the physical scale of the CDA market inherently acts as a moat.
A massive moat.
Yeah.
Keeping the slow-moving institutional funds out and heavily favoring agile private capital.
And by agile, we mean a local high net worth individual can look at a $5 million property, run their own underwriting, see the long-term generational value, and just write a check.
Exactly.
Without passing it through like 5 different investment committees.
Yes. The transaction flow in the CDA market is heavily relationship-driven. You are dealing with people who understand the street-level dynamics, not an algorithm sitting in a skyscraper 3 time zones away.
Which perfectly transitions us into the actual deal flow from the trailing 12 months.
Let's get into the numbers.
If private buyers are driving the bus, what do they actually buy? The data shows 9 total sales comparables over the last year.
Which is, that is a tiny number of transactions for a $1.5 billion market.
It reinforces that tightly held narrative you mentioned earlier.
Owners are simply not letting go of their properties.
Yeah. And the total volume for those 9 deals was roughly $16 million.
Right.
The average deal size was around $8 million. The highest sale touched $15 million, and the lowest was around $1 million.
Now, regarding those buyers and sellers.
Yeah, I do need to pause here and mention a required caveat for you listening. Specific buyer and seller names are not specified in the report. So we cannot verify exactly who bought that $15 million asset. But given the 82% private capital dominance, the probability leans heavily toward a regional private entity.
Yeah, that's a very safe bet. And even without the names on the deeds, the financial metrics of those 9 deals reveal a lot about the underwriting psychology of the buyers.
What do you mean?
Well, the average price per unit on those closed deals was about $196,000. But the most critical metric is the yield.
Okay.
The average transaction cap rate on those closed deals was 5.9%.
Okay, we need to ground this for the listener because the capital market snapshot is where the data gets incredibly revealing.
It really does.
Earlier, in the quarter in a minute, you said the overall market cap rate is sitting at 6.2%.
Right, 6.2.
But actual closed transactions are clearing at a 5.9% cap rate.
Exactly.
That is a 30 basis point or 0.3% spread. Break down the mechanical reality of that difference for us.
Sure. Let's explain a cap rate mechanically. Think of a cap rate roughly like the dividend yield on a stock.
Okay.
If you buy a building entirely in cash today, that 6.2% market cap rate is the theoretical annual return the property's net operating income puts in your pocket.
So the market models are suggesting that investors should demand a 6.2% return to take on the risk of owning real estate in this market.
Exactly. That's what the models say.
But the people actually signing the closing documents are accepting 5.9%.
Yes.
They are willing to take a smaller dividend.
Right.
Wait, I have to stop you there. A lower yield means they are paying a higher purchase price for the exact same income stream.
Correct.
Why wouldn't that just be a mistake? I mean, could this be irrational exuberance?
It's a fair question.
Are we sure private buyers aren't simply overpaying because they have cash burning a hole in their pockets and they just want to win the bid?
It is a valid skepticism. But in real estate underwriting, accepting a lower yield usually signals something else entirely.
Which is?
A willingness to pay a premium for intrinsic durability.
Durability, okay.
These private buyers are looking at that 25-unit delivery number. They know supply is choked off.
Right.
They are betting that these physical assets are going to be incredibly scarce over the next decade.
I see.
So, if you are a private investor listening to this, that 5.9% transaction cap rate is your reality check. It means if you want to win a competitive bid in the CDA market today, you cannot underwrite your deal using the 6.2% market average. You have to be willing to accept a tighter margin to secure the asset.
Man, that drastically shrinks their margin for error.
It really does.
If they're accepting a 5.9% yield, their financing has to be perfectly dialed in, right?
Oh, absolutely.
Because if their mortgage interest rate is higher than 5.9%, they're experiencing negative leverage.
Yeah.
The property is literally losing money every month.
The debt mechanics are definitely the missing puzzle piece here.
Right.
But I must clearly state that as for debt markets, specific rates, spreads, and LTV conditions, meaning loan-to-value ratios, are not specified in the report.
So we basically do not know if these buyers are getting killed by debt service.
We don't have the exact loan terms, no, but we can infer a lot based on the buyer profile.
How so?
Well, institutional buyers rely heavily on cheap, massive debt facilities to hit their required returns. But private capital, especially generational wealth or family offices, often utilizes much larger equity down payments.
Right.
If a private buyer is putting 40 or 50% cash down instead of, say, 20%, they are far less sensitive to interest rate fluctuations.
Because the loan is smaller.
Exactly. They aren't as squeezed by heavy debt service, which gives them the flexibility to accept a 5.9% cap rate.
Yeah.
When you aren't beholden to a massive debt load with a ticking clock, you can afford to be patient.
So if a private investor is accepting a lower yield to win the asset, and they have a ceiling on how much they can raise rents because of local incomes, they are forced to squeeze every single drop of efficiency out of the property itself.
Yes, operations become everything.
Which brings us to the operational reality on the ground. We have the CoStar macro benchmarks, a 7.4% vacancy rate, and a $1,593 asking rent.
Right, but those are the 30,000-foot macro weather patterns.
And ideally, a property owner listening to this would compare those benchmarks against their own rent rolls to see how they are performing. However, I do need to note that internal occupancy and rent data discrepancies are not specified in the report.
Right, we don't have everyone's private books.
But how should an operator actually use this macro data if their own building is performing differently?
You use the macro data as an operational mirror.
Okay.
Like, if the broader market is holding a 7.4% vacancy rate, but your specific 20-unit building is sitting at 15% vacancy, you cannot blame the macro economy.
Right, you can't just throw your hands up.
Exactly. You cannot say, well, the market is just soft right now.
Yeah.
The data proves the market is actually absorbing units at a rapid pace, 770 of them.
Yeah.
That means you have a hyperlocal mechanical problem.
It is the difference between knowing it is raining outside versus knowing your specific roof is leaking.
That's a perfect analogy.
Yeah.
Exactly. Maybe your property manager is slow to turn over empty units.
Or maybe you push your rents to $1,650, blowing past that affordability rev limiter we discussed earlier.
Yes. And your tenant's less for a building, charging the market average of $1,593. This data Basically removes the guesswork.
And it also highlights the danger for specific types of inventory.
It does.
So if we look toward the horizon, based strictly on the data mechanics we have just dissected,
No.
what are the forward-looking watch items you are paying attention to for the next quarter?
The primary watch item is the construction pipeline's impact on Class B and Class C inventory.
Let's explain how this works mechanically for everyone listening.
So, Class A inventory represents the newest, most luxurious, highest rent properties.
Right.
Class B and C are the older, less amenitized, more affordable workforce housing units.
Okay, got it.
We simply cannot ignore the math of 770 units absorbed versus 25 delivered. You need to watch very closely to see if developers start breaking ground on new projects.
Because if they don't.
If that delivery number stays stubbornly at 25, you will see a severe cascading squeeze on the lower tier properties.
Walk us through the mechanics of that cascade. How does that happen?
Well, think about it like this. If a high-income earner moves to the CDA market and wants a brand new Class A apartment, but none exist because only 25 were built, they do not just leave the city. They rent the best available Class B unit instead.
Ah, I see.
That means the middle-income renter, who would normally take that Class B unit, is forced to rent an older Class C unit.
It pushes all the demand down the ladder.
Exactly. And eventually, the lowest-income renters at the very bottom of the ladder have nowhere left to go.
Wow.
Which causes severe operational strain on those older properties.
So the lack of new luxury construction actually hurts the most affordable housing tiers the hardest.
Yes.
That is a brutal mechanical reality. What is your second watch item?
Watch item number 2 is the cap rate convergence.
Right, the gap.
Right now, we have that 30 basis point spread between the theoretical market 6.2% and the actual transaction reality 5.9%.
Yeah.
The market is essentially experiencing a disagreement between the mathematical models and human behavior.
It's a game of chicken. Who blinks first?
Precisely. Over the next few quarters, watch to see if the market cap rate compresses down to meet the transaction cap rate.
Meaning?
If it drops to 5.9, the models are effectively acknowledging that the CDA market is permanently repriced and lower yields are just the new normal.
And what's the alternative?
Conversely, watch to see if private buyers suddenly run out of patience.
Yeah.
If they decide they are taking on too much risk for too little return, they will stop writing checks at 5.9.
And then sellers have to adapt.
Exactly. Sellers will be forced to drop their asking prices, pushing that transaction cap rate back up over 6% to meet the market model.
It really is a massive financial game of chicken between buyers and sellers, all mediated by a severely constrained supply chain.
That's exactly what it is.
Man, we have covered a tremendous amount of ground today.
We really have.
We explored the mechanical failure of supply failing to meet 770 units of demand. We looked at the income rev limiter that is keeping rent growth at a stabilized 1.6%.
Right.
We broke down the dominance of private capital, and we analyzed why buyers are willing to take a 5.9% yield to guarantee their foothold in this region.
It's a fascinating market.
But as we close out this deep dive, I want to leave you with a final provocative thought to mull over.
Let's hear it.
We know that private investors currently have an 82% stranglehold on this market. They are hoarding these assets because institutional funds need massive scale to deploy their billions, and 25 new units just doesn't cut it.
Right, the moat.
But what happens to asset values in the CDA market when institutional capital decides they can no longer afford to ignore this supply-choked, high-absorption gold mine?
Oh, man.
If Wall Street ever decides to change their underwriting rules, or, if a developer manages to successfully push through a massive 500-unit portfolio, the floodgates will open.
It would be wild.
The moment institutional capital enters a market that absorbs 770 units while building almost nothing, the resulting price war could fundamentally rewrite everything we know about real estate in this region.
That's a huge shift.
If you are holding assets today, you are sitting on the fault line of that potential shift. Thank you for joining us as we unpack the mechanics behind the numbers. For a custom market breakdown, contact Eric Peterson at 509-903-9077.